Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Beko, and my partner, Hari. In this episode, episode 26, we will take you through our own checklist. We talked about what checklist is in the previous episode. Let's do a quick recap of what it is. A checklist is a list of questions that people use to evaluate a company, whether if it's a good investment for you or not. This has been popularized, as we said in the last episode, popularized by a well-known value investor, Guy Spier, in his book, The Education of a Value Investor. But this checklist, the concept of checklist, has been used over and over again, I'm sure, in previous to his time and now, still today, in many different investment houses and investment professionals. So let's dive into our own checklist. I just want to, before we go into the checklist, let's just go over the high level bullet points. We read out to you guys in this last episode this quote from Warren Buffett himself in his letter to his shareholder in 1977, and there's a paragraph in that letter that talks about basically his mental checklist, what he goes through before he makes an investment. And it outlines largely four concepts that is so critical. So let's just reiterate that. One, can we understand the business? Two, does the company have a favorable long-term prospects? In other words, does it have a competitive advantage? Number three, is it operated by honest and competent people? And number four, is it available at an attractive price? So those are the four elements that Warren Buffett outlines in his letter to his shareholders in 1977. And we will take that and break it down into sub-questions that sort of addresses those questions collectively. So let's start with question number one. Do we understand the business? So, Hari, in our checklist, what questions are beneath that umbrella question that we usually use to analyze a company?
Yeah, so we usually start with the first question is, what does the company do? Mm-hmm. Right, and I have the caveat in there, you should be able to answer this question in less than 2 sentences. Mm. Right, so if you find yourself having to write a bunch of stuff, it probably means that it's too complex, or that you're not able to concisely, say what the company does, right? And that's okay. Right? I mean, it is not a reflection of your ability if you can't understand a business, right? I mean, we all associate that with intelligence and things like that. Warren Buffett will be the first person to tell you there are lots of businesses he doesn't understand and therefore doesn't invest in, right? This is not a reflection of who you are. But it is a reflection of, where you are in the world in terms of, if you're in healthcare, you'll understand healthcare businesses. If you're in technology, you may understand tech businesses. So there's some industries that are just more amenable for people to understand, and then there are others that are just more complex, right? Or some of these may actually be geographically restricted. So, if you live in the South and a business only operates in the South, you may be more familiar with that business, as opposed to living in the North, you may not have any idea what this business does.
Sure.
So those kind of things are really important to understand. So what does the company do, and how can you summarize that fairly quickly?
Yeah, I think that point is very important. Your limitation to less than 2 sentences, or very concise aspect of it, because from my experience, analyzing big conglomerate businesses, there's so many different branches, so many different subsidiaries. So it's really hard to summarize. Like, for example, what does GE do? GE does several things, right? And to evaluate a company like that is very, very difficult. And maybe that's a flag right there that maybe you should stop and move on to the next one, perhaps.
Yeah, and I think when you start having to consolidate this, right? When you first start out, you should not be investing in complex things like conglomerates and stuff like that. Simply for the fact is that they're harder to understand, right?
Absolutely.
You're basically analyzing 4, 5, 6 companies in one, right? And then, but they all have merged financials and merged, and they have one CEO and all of this stuff. That's complicated, right?
Very
And so that's not something you want to, why beat your head against the wall, when you do that? It's better to start with something where you can really sink your teeth into it, something you're familiar with, and you really understand it.
Yeah.
And then go through the exercise and find all of the things that you don't understand and start learning those.
Maybe this is a good place to ask this question to you. Where did you start? To our listeners, where did you start personally that you really found interesting and easy to understand? So I know retail, for example.
Retail was by far the easiest for me to understand. I started when I was 18, 19 years old, and the fact of the matter is, when you're that young, you don't really know anything. So you've never actually worked, in a real job and understand the real world. So. That's a good place to start.
Retail.
Retail, like companies like Home Depot or Lowe's or, Best Buy,
right.
Amazon. To some extent, Amazon is almost like a conglomerate at this point.
Yep.
And those kind of businesses are fairly easy to understand. One of the disadvantages is that they don't have a real moat, right? I mean, most of them don't have a real moat.
Yeah.
And so those are kind of things that you have to start thinking about. Is there are certain sectors, there are certain areas, but I would start with, if you work in a certain industry, look at your own company, look at competitors in your industry, and then, if there are products and services that you use frequently, start with that. And so these ideas are all where Peter Lynch kind of emphasizes, and for those of you who haven't read his book, One Up on Wall Street and Beat the Street, both of them are fantastic reads. But the caveat to that is, it's not just because you see a lot of people in the store or you know the business well. That doesn't mean you just say, okay, here's all my money, shut up and take my money, right? That's not how that works. You do the analysis at that point, and then you go through the checklist. So,
So, again, just the first question here. What do you understand the business? The first question on the checklist. You started with retail when you were younger, and because it's easy to understand. And Peter Lynch talks about the companies that you frequently use. For example, if you're into Starbucks every day, if you get Starbucks, maybe it's time for you to maybe look at Starbucks.
Yeah.
So those are kind of good places to start because it checks off the first question. Do you understand the business?
Right.
So let's move on from there. You briefly mentioned, retail doesn't have a competitive advantage, doesn't have a moat. So let's move on to that question. That exact question is, does it have a favorable long-term prospect? Does it have a competitive advantage for it to sustain a long-term growth prospect? Yeah,
so I think we talked about this. We did an entire episode on competitive advantage early on, right? And so we talked about those various aspects of what are competitive advantages, right? And so, the first one that you start with is, you think about as brand, right? So I always use my classic example is Disney, right? The Disney brand is everything to parents, right? If Disney blesses it, it's usually good. It's safe to say that my kids can watch it. And so that brand carries a lot of a price premium with it, right? So if a brand is only valuable, from an investment perspective, if it carries with it a price premium or it is a lure for shoppers, or for, people will put their money preferably into that brand over another, right? So I think of Coke versus Pepsi. Pepsi is disgusting. I only buy Coke products, right? And that is a very important part of the brand concept, right? Is if the brand, because the price of Coke and Pepsi is roughly the same, can Coke charge a premium? For me, they could, right? I think they could. But brand, we're really, what you have to think about is, Shell Oil Company versus Exxon, right? Most people don't really care where they put their gas in, right?
Sure.
But they're two very well recognized brands, right? So why you would invest in or put gas in your car from Shell versus Exxon? Yeah, they have some loyalty cards and things like that to give you discounts and stuff like that. So if you shop at one place versus another, but for the most part, their gas stations don't really command any brand loyalty.
Yeah. Yeah. Yeah, exactly. So just kind of recap that. Brand is, one of the many ways that companies can attain competitive advantage. And we talked about, like Hari said, we talked about there's many different ways that a company can attain a competitive advantage, one being brand. And competitive advantage is important to answer the ultimate question of, does it have a favorable long-term prospect? That's the ultimate question, and a way to get there is to have a competitive advantage. And so this question, does the business have a competitive advantage? That's the first question to answer bullet point number 2. And you just go through the list of possible competitive advantages and say yes, no, yes, no. So the first one being brand. Should we move on to the next competitive advantage, network effect?
Yeah, so this one is network effects really applies, the example that, would be good to think about is maybe Facebook or eBay. So why do you join Facebook? Because your friends are on Facebook. Well, so there are a lot of people who have that mentality, is that, Facebook has a lot of, the feature set on Facebook is not necessarily something that's hard to create. I mean, they obviously have solved a very complex problem in terms of scale and things like that. But their real advantage is not their technology. It's the fact that there are a lot of people signed up on there, so then other people sign up to be on that network, right? And that's called a network effect. Think of it with eBay, right? Shoppers are not going to buy on eBay if there are no sellers, right? So you have to get the sellers. Well, the sellers aren't going to come there unless there are buyers, right? And so the way that they did that was, they incentivized people with, free benefits and stuff like that. They got a mix of people, and they started slowly taking those benefits away, and now they have this vibrant ecosystem where you can buy just about anything, right? So network effects are, you bring people to the table because there are other people, already at the table, and as the network grows, it has almost an exponential effect, right?
Right. Yeah, network effect. I think a lot of social media companies rely on network effect for their competitive advantage, for sure. Let's move on to the next one. So we talked about brand. The next one we talked about was network effect. The third thing here is switching cost. So we talked about this in the episode previously where we talked about competitive advantage. Switching cost. Tell us about that, Ari.
Yeah, so switching cost is, if you use a product or service and it is very difficult for you to switch to a competitor, right? So you kind of stick with one and you lock into it. I think a good example of that would be like Quicken. So a lot of small businesses, small and medium-sized businesses use Quicken to do their accounting and so forth. And what they find is that there are other competing products that have a lot of the features that Quicken does. Maybe not all of them. But Quicken charges a premium price for what they offer. But people stick with it because they can't take their data off of Quicken and move it to somewhere else. Because a lot of their business aspects run through that Quicken service, and they attach their Quicken account to other areas so that they can do their taxes and they can do other things with it.
Right.
So, it has this, it's very difficult to move from Quicken to, some other service. People may not remember Microsoft Money was a big competitive product 10 years ago, 15 years ago to Quicken, and you could do your budgets and all that stuff there. And now you don't hear about Microsoft Money anymore because Quicken basically had the market, right?
Yeah.
So
switching cost.
Switching cost is, another good example is also banks, right? Banks basically provide us the same service as everybody else.
Yep.
You don't switch your bank every 3 months because somebody has a better interest rate. You stay with them for 3, 4, 5 years.
Yeah, for sure. Next one, let's move on to the next one. Low cost provider. I think this is a good one to talk about. Yeah,
so this low cost provider is my favorite moat for a lot of different reasons. One of those is that what does it mean actually? So low cost provider is somebody who can provide a service or good cheaper than their competitors, right? And it is a very powerful moat, because if you're able to provide your service, if you have in a commodity business, that is the only way that you can succeed in a commodity business, is to be able to provide your service for cheaper than your competitor. So if you want to think about an oil and gas services business, and I'm throwing this example out not knowing anything about it. That may be why it's a terrible example, but if I am able to pump oil out of the ground at $20 a barrel, that's my cost, and my competitor is able to do it at $50 a barrel, well, I have a much higher profit margin then, right? That's obviously a good thing. But what it does is, let's say that the price of oil drops below $50 a barrel. That means I am the king of Bartertown at that point, right? My competitors will all go out of business or not be able to, compete in the marketplace, and I can take a huge chunk of the market share, right? So in a competitive market, right, all businesses operate in a competitive market. If you think about grocery stores, for example, like, we have a Kroger, here in Houston, we have 3 main grocery stores: Kroger, a H-E-B, and then a Safeway, which, Safeway owns Randall's. And so Randall's is kind of getting squeezed out of Houston. They've shut down some stores, and I think they're planning to shut down, more. And, part of the reason for that is H-E-B has a very strong moat in Houston, and their Hill Country Fare, store brand is very popular. Well, it's also the lower cost, they're a low cost provider in Texas. And so they're able to get, better pricing and that kind of thing. So they're more competitive than Randall's is. Randall's has a very high, they're more of like a luxury grocery store in some ways. So, but low cost provider, another great example of that is Walmart. Walmart really tries to lower the prices of their goods, and they squeeze their suppliers to get better pricing out of them. And then they pass on the savings to their customers. So Walmart, everybody wins in the Walmart world, right? The people who are buying from Walmart, the company wins, and actually their suppliers are able to sell more because they're selling at there's a higher demand there.
Right. So low cost provider, very, very important moat to have for commodity business like oil, for example, or Walmart is a good example in retail. So that was low cost provider. Let's move on to the last competitive advantage we have on our checklist, and certainly there could be more. Intangible assets. Tell us about that, please.
Yeah. So intangible assets are things like patents or trademarks, things that are protecting your business. So the place that you would see this is in healthcare. Drug companies will have a patent on a drug to be able to sell it, and that essentially gives them a government-sponsored monopoly to sell a certain good.
Yep. Now,
that doesn't guarantee that the market wants to buy your good, right? Just because you have an exclusive to it.
Sure.
There may be, you may have a heartburn drug and have a monopoly on this particular chemical formula, and your competitor may have another heartburn drug that is more effective than yours, right? So your patent on your heartburn drug doesn't necessarily translate into profit. So you should be very careful about using these intangible assets, because they have to, and true for all of these things, they have to actually translate into sales for your company.
Sure. Absolutely. So those were the few things, the 5 competitive advantages that we have on our checklist to answer this question of, does the business have a competitive advantage? And please do check out our episode on competitive advantage, because we go into much more detail on this topic. So that's the first question in the second bullet point of, does the company have a favorable long-term prospect? So let's move on to the next question in this bucket of questions here. So the next question is, how durable is the competitive advantage? Oh, by the way, before we move on to this question, just so just to clarify this point, a company can have multiple competitive advantage also. So, a company can have a brand and an intangible asset.
Yeah.
Competitive edge, or a low cost and a brand. Just to let you guys know. Okay, the next question: how durable is the competitive advantage, and what are the risks to the current competitive advantage?
So this is part of that long-term prospects question, right? Is asking, if you think about Walmart, right? 10 years ago, 15 years ago, people were not questioning whether Walmart would be dominant, right? Now the question is Walmart going to survive, the onslaught from Amazon, right? And so, these competitive advantages, how protected are they, and how could they be breached, right? And so this is going back to our topic that we talked about, which is inverting your thesis and looking back and saying, being skeptical about how successful they are. Because when you read an annual report, they will try and tell you their advantages. Mm-hmm. And sometimes they are real and sometimes they're not. And so you have to look at them critically and kind of say, is it real? Yeah.
Yeah, for sure. I think this is a really good question, because a lot of times I'll identify a moat and then just believe that and not question that.
Right.
But it's so important to question that and try to poke holes into it. And this is a question that kind of does that. So, for example, I think we can go through a quick example, perhaps. Let's say, is Walmart's competitive advantage of being the low cost provider, is it breachable? So can other companies do better? Can other companies create a system where logistically they're more efficient? They're cutting out extra that thin margin. Like can they achieve that?
So I think you can start with thinking about it from the perspective of, let's not even include Amazon right now. Just think about, they had Sam's, which is this wholesale warehouse kind of model,
right?
Where you could buy in bulk, you pay for a membership fee. Well, so Costco came and is beating them at that, right? And so they started with the same idea, but they had a financial structure and deals with suppliers where they were more competitive. And I actually prefer Sam's to Costco. I'm one of the few people who think that way, because they have more variety than Costco does. But most people have, they're willing to put up with less variety for more, more discounts, right? Yeah. So Sam's is more expensive, but Costco provides a better price to them.
Right.
So, when you start thinking about it like that, there are a lot of things that you can go down. So like for Walmart's case, a lot of people used to go to Walmart to pick up a bunch of stuff. They'd get their groceries, then they'd go pick up their, toiletries, and maybe they needed to pick up some bath towels or something like that, right? So they could do a one-stop shopping. Well, now a lot of that stuff happens at Amazon, right? And so people are buying a bunch of stuff on Amazon. So Walmart, somewhat late to the game, started doing e-commerce, right? And then they've started buying up e-commerce stores to kind of help them compete in the Amazon world. Yep. So, Amazon is succeeding. Obviously, they're doing very well. Walmart is still doing very well, right? I mean, it's not like they're hurting for money. Yep. And maybe there is just room for two players in this space.
Sure.
But what it may mean is that other competitors, some of the grocery stores may be getting squeezed. Some of the niche retailers may be getting squeezed out of the marketplace. So you really have to start thinking about it. What is their place in the world? Which is, Walmart is going to always serve, the lower socioeconomic spectrum, because their pricing is very competitive, and not everybody can afford the Amazon Prime fee. Yep. So Walmart, I think, their shot across the bow was free 2-day shipping on any order above $35, right, or $25, whatever the number.
Walmart, $35. I think.
$35. Yeah. So, and they have an enormous infrastructure already in place that Amazon is still building out to be able to ship to your door. Yeah. Right. So so there's a lot of things there, and in just 2 minutes we kind of walked through a fairly complex thing.
Yeah.
So, but that's what you would have to do, right? Is how do you protect Walmart's competitive advantage? And if I'm the competitor, how do I breach Walmart's competitive advantage?
Exactly. And just being able to take all that and synthesize that information into some sort of conclusion there to arrive at some sort of conclusion of, okay, does the company that you're analyzing, can the competitive advantage be sustainable, and withstand the attack from competitors to breach that moat? So that mental exercise is very important, and that's the second question in the second bucket of questions to answer the ultimate question of does the company have favorable long-term prospect? Let's move on to the next question. This is just continuing down the discussion of competitive advantage. What is the company's long-term prospects and runway for growth? I think so. Really, what is how big is the pie? How can the company get more of the pie? Is the pie growing itself? That's the question here.
Yeah, and I think if you're early on in a company's world, right? When Walmart first started, there was only very few national retailers, right?
Yep.
They were mostly state by state. So they started with like 2 or 3 stores, and then they went public.
Yeah, they started in rural town.
Yeah, and so
Arkansas. Yeah.
What they said is their market is thousands of stores all across the nation, right? So their runway for growth was enormous, right? They had this model worked out where it was working very successfully. Now you could question whether or not it would work in what worked in Arkansas, would that also work in Oregon, right? But so that long-term prospects are how and then what are the competitors that could come and unseat the horse there?
Yeah.
Right. So the idea here is that in for example, tech companies get disrupted all the time with newer technology, better technology, faster technology, cheaper technology. So what was popular 10 years ago gets disrupted much more frequently than in the non-tech sector world.
Sure.
So you can say, like, what is Facebook's long-term prospects for growth? Well, I would argue, they have 2 billion users already, right? There's only 5 or 6 billion people in the world right now. Most of those people, are they going to sign up for Facebook? I think there are a lot of people who are, so it's very hard for me to say what's going to be Facebook in 5 years, whereas I think Walmart will still be around selling goods, and Facebook probably will be still around,
Sure.
but will it be the same company it is today?
Yeah.
And I don't know.
Yeah. To that point, I think good comparison could be, like a company that we analyzed yesterday, for example, in the meetup, the car industry, for example. We talk about Fiat Chrysler, it's already selling, many millions of cars around the world. How much growth is there for this company?
Yeah.
Versus, let's say, a small, like online banking, for example, or live streaming industry, for example, esports industry as a whole.
Right.
You see, we're talking about there's two different. It's very, very different. And even by mentioning esports and car, there's something in your brain that tells you, oh yeah, esports, it's a new thing, and retail, you've seen it around the block. And so that's what we're talking about in this question. For this question, that's what we're talking about here.
Yeah.
Okay, let's move on to the next question in this bucket. Does the company require a lot of capital reinvestment to maintain its business? I think this is a really good, really, really important question. And the follow-up to that question is, can it grow without any further investment? So basically restating the first question. But I think this question is very, very important. And Hari, take it away.
So I think I actually think these are two separate questions. It's not just a simple restatement, but let me kind of explain.
Okay.
So if you look at companies like the car industry, right? Fiat Chrysler, if they want to make a car, right? They have to design an entire plant around like 1 or 2 specific cars that they're making,
Yeah.
right? That takes a lot of money to do that, right? And then once you build that plant, you have to continue to make reinvestment into the plant to maintain it, right? So when we talk about that, what that money comes from is your profits, right? The profits are where you use that, you take that money from your profits and then plow it back into the company. So there are businesses out there that, like car manufacturers, where they have to take a significant chunk of their profits and reinvest it just to maintain their business, right? And that's not necessarily a bad thing. But that may actually keep maybe in and of itself a competitive advantage, right? That there's a high cost of capital to just start into this industry.
That's a good point.
But what that also means is that you as an investor, may not be seeing the returns that you would like to, because they're having to reinvest every dollar back into the business, right? Now, can it grow without any further reinvestment? And the reason I separated that question out is, if you think about tech companies, right, that if I'm making Microsoft Office, right, I write the code to make the application, and then I'm shipping CDs to my customers, right? The cost of the CD and the packaging is like $1 or $2, right? Not very expensive, right? So my fixed cost it costs $1 million to make the first one, and then the second one costs a few pennies, right? And the second through the next billion cost a few pennies, right? But I'm still selling it for the same price. If I can grow without reinvestment, that is a very, very awesome business to be in for a lot of different reasons, right? Mm-hmm. That business allows me to just plow my money back in, or keep all of my profits without having to reinvest it. So that's why you want to think about that one, as a separate entity, right? Can I grow quickly without having to because I can then extract the money and pay dividends and things like that.
Yeah. So that's the fourth question. Let's move on to the next question in this bucket. Does the business have favorable relationships with the following: customers, suppliers, employees, regulators, communities? So this question, can you elaborate on this one, please?
Yeah, so the idea here is to make sure that there isn't something that'll disrupt the business, right? If they don't have a good relationship with their customers, obviously the customers are who pay for stuff, right? Yeah. But if you have a hostile relationship, is that going to affect the business, right? Sometimes your suppliers may be disrupted because of tariffs. They may be disrupted because they're in China and their government is, limiting the sales of the items to you. Same thing as employees, right? Fiat, Chrysler, and other car companies have unions that they have to deal with, and the unions could say, we're going to go on strike. Yep. And when they go on strike, it may be a huge disruption to your business, right? Yep. So really what you're looking at when you answer these questions, and I think the best way is to actually see us, do it in a real company, is what you're trying to understand is what is going to ruin my business, right? Do I have these relationships that are protected? If the answer is that, yeah, they have good relationships, but they could go sour, well, then you have to be a little more cautious, right? Yeah. About that. And, regulated businesses are one that you have to be really careful about, like healthcare. If you offer a medical device that Medicare is paying for, and then one day Medicare says, well, we'll pay you, but it'll be 20% of what we were paying you before, well, then suddenly your revenue just gets cut by 80%. So that's not, no good. So you want to be able to answer these questions, because this is how you can disrupt your own moat, right? Yep. Is by losing these, relationships.
Yeah. And sometimes answering these questions can be very difficult. Like, how do you assess the relationship between the business and customers, business and suppliers, and employees and regulators, and communities? Sometimes it is difficult. So it takes a little bit more, internet gymnastics to, try to go to different websites to understand, what is the community. And one of the things that I often look at is one of those Glassdoor is a good one that I look at sometimes. And there are different, news articles that talks about strikes and things like that. You could look at that also, aside from obviously the 10K that's available for you. Let's move on to the next question. I think this should be the final question for this bucket of questions here. Is the company able to translate its moat into high returns on capital? Take it away, please.
Yeah. So this is really, really important, right? So we've talked about this throughout the discussion so far, is the only thing that matters is if you own a business is how much profit you can get from the business, right? That's what investors care about. If I have a moat that is a good brand and people love it and stuff like that, but I am losing money on every deal, right? So think about Uber, right? Uber is not publicly traded, but people love the service because they're able to go, I don't have to worry about parking. I don't have to worry about this. But every ride is still being subsidized by their investors, right? They're not able to make a profit. Now, maybe that changes in the future. I don't know.
Yep.
But the important thing to understand is I have to be able to generate a profit, right? And if I can't generate a profit, or if I can generate a profit, is it as high as another company, right? And this is how you start determining. I found two good companies. One has a return on capital of 20% and one has a return on capital of 10%. Well, the one with a higher, if I invest $1 into the business, I get 20 cents versus $1 gives me 10. It's a no-brainer, right? And so this is where it really matters is this moat actually matter to the company? Like they may have a good brand, they may have network effects, but they still don't make money, right?
Yeah. So I think this question, like you said, is so important. Can you translate? I'm going to just reiterate the question because I think the question is well written here. Is the company able to translate its moat into high returns on capital? So is the company able to translate its intrinsic competitive advantage into dollars effectively?
Right.
And if you can't do that, then you got to move on to the next one.
Yep.
And this is, again, going back to our discussion about an opportunity cost. If you can find a company with a returns on capital of 40%, versus, like you said, 10% or 20% to 10%. You're obviously going to go with the 20%, the higher one. And so this is really, really important to answer for yourself, to answer the ultimate question of, does the company have a favorable long-term prospects? We covered a lot of grounds here today. Let me just do a quick overview of what we talked about here. So the first question, again, let's just go back to the 4 large buckets. Number 1 is, do you understand the business? Number 2, does the company have a favorable long-term prospect? Number 3, operate by honest and competent people. Number 4, available at an attractive price. So out of those 4 questions, we didn't get to 3 and 4. We'll cover that in the next episode. 1 and 2, we covered, do you understand the business? Number 2, does the company have a favorable long-term prospects? And to get to those questions, we covered a series of questions that answer those questions ultimately. And the question number 1, do you understand the business? We talked about limiting yourself to less than 2 sentences. You got to be able to understand and deliver, describe the company in less than 2 sentences. If you can't, then you might want to move on to a different company to analyze. It probably is too complex for you to analyze if you can't answer this question in 2 sentences. The next question, competitive advantage, we went through a list of them: brand, network effect, all the way down to intangible assets. And then we cover the question of how durable is your competitive advantage? What are the risks associated with the current competitive advantage? We talked about the long-term prospects, the different marketplace. We talked about the car company versus, let's say, esports. And then lastly, we talked about the relationships and the high returns on capital. So it's a lot there, and I do want to point this out. If you guys would like a actual printout of this, please email us or send us a tweet. We'd be happy to send you guys a PDF of our checklist so you can have it, and maybe for the next episode you could listen to our podcast with this in front of you, because it certainly helps you to kind of have an outline when we're talking about this stuff. So email us at info@valueinvestor.org or tweet us. The handle is ValueInvestorTV. Make sure you do that. In the next episode, we will talk about the last 2 questions. Is the company operated by honest and competent people? And the 4th question, is it available at an attractive price? We'll talk about that. We'll talk about those 2 questions in the coming episode. Anything else you want to add here in this episode, Ari?
No. I think we covered it, and we'll be going through it more, and in a month or so, we'll start talking about real companies and using the checklist. So if there are concepts you don't get, don't worry. You can, we'll be covering it over and over again going forward. So
Absolutely. Thank you all for joining us on this episode 26. We will see you on the next episode. Thank you all.
All right. Thanks.